how to get 100% funding for your property projects. I mean, it's always a popular topic of discussion, and even more so at the minute, right? Because right now we're in the position in the market where lenders are withdrawing their funds or they're de-risking their portfolios, right? There's lots of lenders out there where, and I'm sure you've seen over the past few months or so, as soon as the market started to turn, as soon as there was even the indication that the market was going to turn, lenders started de-risking their portfolios. What we mean by that is there might have been a lender out there that lent on buy-to-lets, and they were happy to lend on buy-to-lets at, let's say, 90% loan to value and 2.5% interest rate. And that was their product. That was their product for a fixed term. And a lot of those products have been withdrawn. Now, to be fair to the lenders, the overall number of products available on the market hasn't changed as dramatically as the media would have you believe. Because if they've withdrawn a product at 90% loan to value and 2.5% interest rate, they've probably replaced it with something that's 80% loan to value and 3.5% interest rate. And lenders have been doing that for the last 6 months or so. Now, that's what we mean by de-risking their portfolio, because the less lending they have in any one loan, you know, as a percentage, then the less risk there is for each of those lenders. So if a lender has 90% in the loan, that's obviously quite a high risk for them. If the lender has 50% of the value of the property in the loan, that's a much lower risk. So they've been de-risking their portfolios and lowering the loan to value that is available. Now, what that means to you is you need more money in your pocket. Because if you had been able to get a 90% loan to value loan, now you can only get a 50% loan to value loan. Well, who's going to make up that shortfall? It's the developer, right? It's whoever, well, it's basically not the lender. So the developer needs to find a way to make up that shortfall. And they now need more money than they have ever needed. Now, let's be honest, this situation is not going to last forever. You know, the economy and the way that the sector performs is cyclical, right? We're going to go around in cycles, and this is just the part of the cycle where lenders are withdrawing from the market, or they're de-risking their portfolios, and that means that you need to put more money into the property projects that you buy. But that also means, and this is the irony of this situation, isn't it? This is the kicker. You probably find the best deals here at this part of the cycle, even though the lending is the hardest. But that's because the lending is the hardest that you find the best deals. So if you can find a way to still fund your projects, this is the point in the cycle where in 10 years' time, in 15 years' time, you're going to be talking about the deals that you did now. You're not going to be talking about the deals that you found in 2019, 2018, 2020, because they're just not that exciting. But the deals that you find now could be those deals that are like a 40%, a 50% reduction, or 50% lower than the surveyed value of the property. That's a proper below market value deal. But the reason that you can find those deals now is there are fewer people out there that have access to funding. So if you can solve that problem, if you can work out a way to get funding, or you can work out a way to manipulate the situation so that the funding that is available to you will do, then you are head and shoulder, in fact, not even head and shoulders, you're waist, stomach, chest, head and shoulders above anybody else that is still operating in the property space. And this is one of those great examples of solutions-based thinking. This is one of those great examples of, well, I used to do it by going to, I don't know, let's use a random lender. I used to go to Together, and Together would give me an 80% bridge, which was fine. And then I would refinance it onto a 75% buy-to-let mortgage. And that used to work really well for me. That's not available now. So you can't do it. Buy-to-let is dead. You know, those kind of just ridiculous headlines. Not the case. It just means that because you're solutions orientated, you now need to think of a new solution. You need to think of a different way of solving the same problem. And that's what we're all in it for, right? That's what we all love, that part of property, because things change all the time. Legislation changes all the time. Demand changes all the time. It's up to us to find out a way to still make that work. And that's what we're here for. So I did this presentation, just to be completely transparent with you. I did this presentation at the Property Investor Show. When was it? October. And it went down really well. And I thought, look, if I'm going to do it in front of 100 people at the Property Investor Show, I should really do it in front of our webinar audience who come and check in once a month and find out what kind of stuff that we're talking about and our insights into the marketplace. So I thought, look, this is a great webinar for you guys, especially at this point in the cycle. So let's have a look at what we can do. So first of all, about me. I've rabbited on so much, I feel like you already know me. My name's Chris Kirkwood. I am the franchise director here at Sourced. I've been the franchise director almost since the very beginning of Sourced. So I've been here for 5 years. And before I joined Sourced, I founded, scaled, sold businesses across different sectors, including in the property sector. But it's my sort of thing to get involved in businesses right at the very start, to see the potential in those businesses and to build them and scale them and systemize them and get them to a point where they're absolutely humming. And you know, we were able, me and the managing director of Sourced, worked very closely on achieving that through the franchise over the last 5 years. And to me, like a lot of you guys, I think property was a sideline. And I started it about 15 years ago. Property was on the sideline, really wasn't, it was just like where I was parking the extra money that I was making. But then I started doing it a little bit more seriously because I wasn't making as much money as I wanted to. So I put some more of my time and attention into it. And I soon realized that the choices, the ways that you can go around solving problems in property are absolutely infinite, and it's a very exciting place to be. And that's what I love doing now. I love looking at properties, I love looking at projects, and I love finding ways to make them work. And that's how we train our franchisees at Source, but I'll tell you a little bit about that later. We developed the no upsell property core training approach here at Source. So for our guys, we give them full transparency to have absolutely everything. And when I say absolutely everything, we are property developers. We love property. We are property people. That's where we come from. So we've amassed a wealth of knowledge over the past, 15 years for me, probably 20 years for Steve. We've got some other guys in the business that have been in it for decades as well. We've amassed a wealth of knowledge. We put all of that together and we make all of that knowledge available to our franchisees, and there is no upsell. You become a member of our network, and that's it. Assisted lots of transactions. Well, I stopped at 350 million because I thought that was probably enough. But assisted and advised on many, many millions of pounds worth of transactions because I was a property consultant before I started with Source. And like I said, it's all about solutions-based thinking, and that's the biggest attribute that you can have if you're coming into property. It's not whether you've been a project manager before. It's not whether you know how to lay brick. It's not whether you know what fireboard is, or what kind of fireproof door you need on a HMO. That's not it. The real X factor of people that do well in property is always looking for solutions and always looking for better ways to go about business. So what we do at Source, let me just be completely transparent with you. What we do at Source is we do training, support, leads, and we have the Source network as well. And that's what we offer on Source franchise. And then we have funding as well. And that's why I'm in the right position to talk to you about this 100% funding thing today, because we have a funding platform. So the training, the information that we give our franchisees is relevant because we know what funders are looking for. Because I sit in my desk in Sourced HQ, I look over to my right-hand side and I see Derek Pratt, Commercial Director of Sourced Capital. And if I want to run something by them, if I want to say, look, I've got this idea, will this pass for, generating a higher loan to value on a project, then I can just go over there and I can sit down and I can ask them and we can talk about the technicalities of it. And so we at Source have this incredible insight into what funders are looking for. And Source Capital is an FCA regulated peer-to-peer lender, right? So Source Capital and the guys at Source Capital are absolutely committed to making sure that those loans go through in an ethical and FCA compliant way. So they are absolutely committed to looking after their lenders, the people that lend money into the peer-to-peer platform. So if we know that it can work with Source Capital, it can work with the majority of lenders out there, and that's why we're in this position. So when you join Source, you have a 5-year contract. And like I said, there's no upsell. Now, let me tell you about our perspective when it comes to property courses and the way that we then apply that into the solutions for, because it is relevant for the solutions I'm about to tell you. So you need to understand this part to then move on to the solutions for me to explain what we're doing so that you understand how it all fits together. Now, our perspective is, you know, there's lots of training companies out there and they have the different methods of trading. So HMOs, flips, buy-to-lets, new builds, whatever they might be. And really the reason that they've been split into those sections is because it's easier to sell a course. It's easier to say to somebody, come on my weekend course for HMOs, it'll cost you £2,000, and then I'll upsell you onto the big daddy HMO course, which will cost you 10 grand. It's got nothing to do with the information, and that's the important thing. And that's not how we train people. That's not how we open people's eyes to what the opportunity is and what the things that are holding them back are. The way that we do it is contracts, finance, and legislation. And if you understand contracts, finance, and legislation, then actually the stuff that you need to know for each specific course is relatively small. So what I mean by that is, if you buy a property and you turn that property into a HMO and then you sell that property, the majority of what you've just been through is very similar than if you bought a flip and you converted that property and then you sold that property, or a commercial conversion. If you bought that property, you converted that property, and then you sold that property. The buying part, the selling part is both very, very similar. The technical part of the build is different, but in most cases, you're not the one that's doing the technical part of the build. You've got a build team in place who are handling those technicalities. You've got an architect, you've got a project manager, you've got a quantity surveyor, especially if the builds are quite big. So what we focus on as our core property training is contracts, finance, and legislation. Because if you understand how you can manipulate these things, you're gonna secure more deals, you're gonna do more deals, and you've got the right team in place and the right contracts in place to secure that team. You're gonna have the security of knowing how you can make that work. So what we do on our induction, we talk about topics that cover HMO and buy-to-let and new build, and pretty much every course, because there's so much that is similar. And then on the flips and refurbs course, we cover stuff in the flips and refurbs course that covers 5 or 6 different courses that other people would put on there, because it's always the same information. And our objective, because we're tied to our franchisees, we're in a business relationship with our franchisees for 5 years. Our objective is to make them as successful as possible, not just fill their heads full of information and push them out the door. We're there to make them as successful as possible because it's a business relationship that we have with them. And that's why I'm happy to share the kind of information that I'm going to share with you guys today with the franchisees. We have these conversations all the time. We have an internal system called Workplace that we go on. I was answering questions this morning on Workplace about different ways of structuring deals. You know, we have that relationship. So I'm happy to give you this information, and I hope it helps you today. But this is the kind of conversation that we have with our guys all the time. So first of all, let's look at the finance options. Let's get into the meat of this. So you've got short-term finance, you've got long-term finance, and you've got finance that sort of covers all bases. So short-term finance, you've got either bridging finance or you've got peer-to-peer finance. In long-term finance, you've got mortgages or you've got commercial mortgages. And then the stuff that covers everything is like JVs, because you know, that's just completely down to your negotiation. Now, bridging, peer-to-peer, it's higher cost, but you only take it out for a short period of time, because what you're normally able to do with bridging or peer-to-peer finance is borrow more money than you would be able to from a mortgage or from commercial finance. And then you do your project because you're able to borrow more money from bridging or peer-to-peer, and then you refinance onto a normal mortgage or a commercial mortgage if you're looking to keep that property, because longer term finance from mortgages or commercial tends to be lower costs. So you've got the high cost short term and you've got the low cost long term, and it's all relative. You know, I know mortgage prices are going up at the moment, so that's all relative. Bridging and peer-to-peer will still be more expensive than mortgages or commercial. So they're your options. That's what you can play with in order to find out how you can generate 100% funding. Now, there's some really important points in this table that I want to draw your attention to, because when you take out a mortgage, what is the mortgage based on? The mortgage provider will say to you, yes, we'll be happy to lend you 75% of that. property. Now, mortgage providers will call that a loan to value, but in most cases that is not accurate. It is not a loan to value that most mortgage providers use to calculate what they can lend you. In most cases, they use a loan to purchase price, because the mortgage company will use the valuation of the property or the purchase price of the property, whichever is lower. Because again, what they're looking to do is look after themselves. They're looking to de-risk that situation. So if they use the lower of the purchase price or the valuation, then they'll be at a lower risk. So let's take an example of that. So let's say that you see a property on Rightmove for £100,000 and a surveyor goes round and they survey it at £100,000, but the offer is accepted at £90,000. Well, it doesn't matter what the surveyor's valuation is at that point. The mortgage company is going to say, well, you're buying it for £90,000, so I'll lend you 75% of £90,000, not 75% of £100,000. Now that's fine, right? That's the situation that we've dealt with that way of dealing with things for a long, long time. But there are places out there that, regardless of the purchase price, you can still buy the property and you can still get lending from the property based on the valuation, not the purchase price. So in that same situation, if you find somebody that's got a property that's for sale for £100,000 and you're buying it for 90, I know lenders that are out there that will say, well, absolutely, we'll still give you 75% of the valuation. So we'll still give you the 75 grand, even though you're buying it for 90, not 75. I know that, and I know that for a fact because I know I sit opposite one of the lenders that does that. Source Capital still offer loans based on the valuation instead of the purchase price. So that's the first thing that we need to take into consideration. Like, all lending is not equal. There are very subtle differences between lending that actually have very significant effects on the way that you can structure a deal. So let's next look at conveyancing. So as you will know, I'm sure, you have the offer, the exchange, and then finally you're going to complete. And your first charge lending can be secured against the property upon completion. Anything that you need prior to completion, you're going to need to find either from yourself, or you're going to need to get funded from an investor or somebody else that's putting money into that project with you. This is obviously very important for taking into consideration if you're going to be going through planning, if you've got big upfront costs that you need to take care of. But this is, again, one of the opportunities that we address at Sourced with our franchisees that other people don't really talk about, because we help our franchisees raise those upfront costs. We don't just say to them, look, it's going to be an upfront cost. You haven't got 100 grand to put into the planning for this development, and therefore you're not going to be able to do it. Absolutely not. We come up with solutions for our franchisees. So we allow them, they can advertise out to our investor database, and they can look for people who want to put in those upfront costs to help them purchase property. In fact, I've got one franchisee, he's buying properties in the Northeast, and he's using investors' money to fund the upfront costs for each and every property. He's putting no money in himself. He's just using the investor money for what the lender won't lend to him. But all he's doing is adding properties to his portfolio. I also know somebody else, this was pre-sourced, pre-joining Sourced. I heard of a couple of guys who were working with investors to do exactly the same thing, and they were buying HMOs. And their strategy with those HMOs was that they were going to keep the HMOs between these guys that I knew and the investor. So the investor puts in all the money, these guys find the HMO, they convert the HMO, and then they hold the HMO between them. The finance split, or the income split based on that HMO generating an income, was 80-20. And the 20 went to the person who put the money in. The 80 went to these two guys that I knew. And they had many, many, many of these HMOs. This is not an irregular thing. So when we're talking about, and when we go into the main ways of structuring these deals, we're talking not only about the theory, but we know people that do this. We know that this is possible, and we know that there are people out there that are making money from property by doing the things that we're going to be talking about. So first of all, if you've got upfront costs, if you need to do things to get the property to the point of completion, That is absolutely possible by raising funds from investors. There are plenty of investors around out there. We have a portal that our franchisees can use very easily in order to find those investors. But if the franchisee doesn't want to do that, we've also created another system whereby we can joint venture with them. We can do that work with them, and we'll put in those funds to work with that franchisee to get that deal across the line. And in fact, one of our franchisees from the Southeast has just had a JV accepted on a big commercial building, which we're going to turn into flats in around sort of Cambridge area. So that's the next deal that we're going to be doing with one of our franchisees, and that franchisee won't put in a penny. We'll cover all the costs, but she will get a percentage of the profit at the back end of that deal. So first of all, let's as we're looking through exchange, we need to address the sort of the habit that people have got when a property goes through exchange, because most people assume that they need to leave a 10% deposit on exchange of contracts. And most people assume that they need to leave a 10% deposit because they're asked for a 10% deposit. It's that simple. The solicitor will ask them for a 10% deposit, and so they will leave a 10% deposit. But actually, if you look at the contract, if you look at the exchange contract, it will state that you are liable for a 10% fee should you pull out of that property. But that doesn't mean that you actually have to exchange the money. It doesn't mean that you have to give the money to the solicitor for the solicitor to hold in their client account. You can negotiate that down. Now, money does need to change hands to make the exchange contract legal, but you can exchange hands on £1. So instead of leaving 10% of the value of the property, you're now able to leave £1. And again, you might think, well, why would anybody do that? Why would anybody go for that? It doesn't make any sense. Surely nobody's going to accept that kind of reduction. Well, you've got to think about it, think about the positives, think about the solution that you're creating. I'm going to go to an agent or a solicitor and I'm going to say, listen, I don't want to leave 10% on exchange of contracts. And the reason that I don't want to leave 10% on exchange of contracts is that everybody involved in this deal needs to get to completion, right? Your guy needs to get to completion because they want all of the money, not just 10% of the money. They want all of the money. And I want to get to completion so I can start this project. Now, if I keep that 10%, I'll give you £1 or I'll give you £1,000 or whatever is a reasonable amount. I'll give that to you, but I want to keep the rest of that money because I want to spend it between exchange and completion to get to completion. So what I'm saying is, if I keep that money, we'll get to completion sooner. If I give you that money because I need to give you the full 10%, which I can, it just might take longer to get to completion where everybody gets to exit winning from this situation. It's up to you. We go through that negotiation all of the time. And people are much more reasonable than you would give them credit for. And people, again, share that goal of getting to completion because that's where everybody wins. So instead of having to have that 10% money in your pocket or finding that from an investor, you can now negotiate that down. Now, to be completely transparent with you, where I negotiate that is in the initial offer, because I know that I'm going to have to put down, or I know that I'm going to get asked for a 10% deposit. So what I tend to do is when I'm making my offer and I'm typing it out, because I always put offers on a PDF, a letter-headed PDF and send it across to the agent. When I'm typing that out, I will type out that I want to offer, let's say, £400,000 for the property, and I would like to leave a 2%, or whatever I think it is at the time. I would like to leave a 2% deposit on exchange. I still accept responsibility for the 10%. However, I'd like to keep 2%. I'd like to leave 2%, keep 8%, so I can get to completion quicker. And I put that in the initial offer because I guarantee at the initial offer, they couldn't give a monkeys about the exchange, the amount that you're leaving on exchange. All they care about is the offer, how much you actually offering. So this is, that's something that you can do to change in the exchange contract. Secondly, the next thing that you can do is you can extend the completion. So an exchange of contracts, and then you extend with delayed completion to give yourself time between exchange and completion. And the reason that you would do that is so that you can get into the property and you can start doing the work. Now, if you get into the property and you start doing the work, it means that when you complete on the property, you might have already finished the work. So instead of the property being worth £200,000, like when you're buying it, what you're paying for it, the property is now worth £600,000 or £300,000 or whatever that uplifted value is. Now, you've not had any borrowing costs. You've not borrowed yet because you haven't actually completed on the property. But the way that you've structured the deal and negotiated is that you've got access to the property and the property is empty. This is a great strategy for, those old people's properties who they've moved into care, but the property hasn't been updated for 20, 30 years, and it's looking very, very tired. It's a great strategy for that kind of property. Now, if you've extended that completion and you've done the work between exchange and completion, you can now borrow against the property at the higher value, not the lower value, which gives you a huge amount of options. So let's move through and let's go to the ways that I'm going to show you to maximize your position and potentially get up to 100% borrowing. So let's have a look at these 5 ways. We're going to look at higher contribution. We're going to look at other security. We're going to look at below market value. We're going to look at creative purchases. And then finally, we're going to look at joint ventures. So higher contribution. So this is an obvious request. And like I said to you, this is what they do to de-risk their portfolio. So instead of giving you an 80% loan to value, they'll give you a 60% loan to value. So they're asking you for more money. Now, if you can put more money in, fantastic. But most people's reaction is, oh God, I don't have that money. I can't do it anymore. I need to walk away. This doesn't work anymore. This is crap. That deal was amazing, but I can't do it. That's what most people will think. I absolutely guarantee it. But because we're solutions orientated, we look at ways to solve that problem. So what we do is, first of all, we show our franchisees how to build an investor database and how to nurture that investor database. So we give them access. We show them how to go out there to start talking to investors and to then nurture the investors. The CRM that our guys get actually holds the information for those investors and sets them prompts and tasks to remind them, hey, you haven't spoken to this guy for 2 weeks. You need to go and speak to him. To keep those investors warm, to keep those investors interested in what you're doing so that they don't disappear and find somebody else to put their money into. And it's really important that you nurture these guys before you actually need them. Because what will happen is if you need 50 grand because you've got a project going through and it needs another 50 grand up front for you to have all the money together. If you need that 50 grand now, well, you go out there and you find somebody with 50 grand. You've then got to build credibility. You've then got to do all the due diligence with that person. And that can take weeks and weeks and weeks. And by the time that comes through, you might have lost the deal. So the key is that you talk to these people and you nurture them before you actually need them. Because if you wait till you need them, you've probably waited too long. Now, when you're talking to these guys, this is one of the questions that I get asked a lot. What kind of security can you give them for their investment? So if they're going to put 50 grand in and you've agreed to pay them back at, you might pay them 60 grand back in 6 months or in 12 months or whatever, then what security do they have over that 50 grand? Well, you've got a number of different choices. Now, if you've got a lender involved in that project, you're probably not going to be able to secure it against the first charge. But you could, with the lender's permission, get a second charge. Now, that's only if the main first charge holder agrees. Now, if they don't agree, what you could do is you could put an RX1 or a restriction on that property to the same amount of money. That means it is legally registered against the property. And whereas you can't force the owner to sell the property, if that RX1 goes into default, what you can do is you sit there, it's registered against the property, and when the property sells, you are registered to get your money back out of the costs or out of the income generated from the property. So you've got an RX1, and you can get them really easily from. There's a small charge, but you can get them from the HMRC website if you Google RX1. You can do a personal guarantee against you and your assets, or you could potentially do a shareholding. So if you're going to structure your property deal by putting it into a into a limited company, into an SPV, then they could own a percentage of the shareholding that holds the property. Now, you need to take that into consideration, and you need to probably talk to your accountant about how you're going to structure that deal. But again, that's a great way to provide security for the person that's putting the money in. So just because you don't have a first charge doesn't mean that you can't provide security. There are many different ways. And the way that I would structure that, the way that I would have that conversation with the investor, is by asking them what they're looking for. Because to be perfectly honest with you, some investors won't even require security. They won't ask for security. But if they do, you know what your choices are. And if this is the first time that you've heard of this kind of paperwork, this kind of contract, then what I would suggest is you get to know them and you understand what the differences are between those four things. Now, a couple of weeks ago, two of our franchisees went out on our investor database, and within 24 hours, they had 65 investors inquire about their deal and inquire about putting money in upfront for one of the deals that these guys were doing. So that's how many investors, that's the sort of appetite that is out there for investors or for people that are investing in property. Those 65 people translated into over £100,000 worth of investment generated from those investors to invest into property. Over £100,000. What could you do with £100,000? If you had £100,000 in your pocket and your remit was to generate an income from property, is that something that you could do? Would you find it easier to generate an income from property if you had more money in your pocket? Because that's what we're doing for our guys, and that's what right now, that's what our guys are doing incredibly well. So you can do, again, the way that you structure your deal is completely up to you with the investors that you're dealing with. You can do it as a set return, you can do it as an equity stake. Again, it's down to them. It's down to having a conversation, and then from that conversation coming up with a solution that wins for everybody. Because what will happen is you'll have, look at these guys, 65 conversations, and then you choose the people that you want to move ahead with. Some people will say, I want an equity stake, and that might not be what you want to do. So at that point, you say, look, it's not what I'm looking for. I'm looking for more of a set return, but no ownership. If you can do that, great. If you can't, then I'm sure there's somebody out there that you can work with. But you're the one that's calling the shots because you're the one that's got all the power. Not these 65. But there's 65 people trying to get into this deal that these guys have found, and there's only one deal. So whoever holds the control of the deal has the power. So that's the first way. Like with a higher contribution, you're not necessarily expected to have that money in your pocket, but you can go and find that money from other sources, which means that, again, that's 100% funding because you get your funding from your lender, you get the shortfall made up by the investors, and you don't need to put that money in yourself. So the second thing that we're going to look at is security over another asset. Now, in this one, it seems fairly straightforward, but a lot of people don't. A lot of people have never been there because they've built a portfolio and they've never really looked at ways that they can leverage investment or leverage mortgages in order to continue to grow their portfolio. So you could leverage the portfolio that you already have or other assets that you already have. I drove through Wilmslow the other day. I noticed that you can take out borrowing against your supercar. There's a shop in Wilmslow town centre that allows you to do that, or against high quality or big brand watches and jewelry. You can leverage those things now, so you're actually borrowing against them, and you can then use that money to invest into property. So it takes advantage of your equity. So you've already got it there. You're fully in control of it because this stuff is already there. And it means that you're still keeping your portfolio. You just maybe refinancing some of the properties in your portfolio. It's really straightforward, really easy. If you talk to a broker, you'll find out what kind of rates are available. But then what you can do is you can use that borrowing that you secure against the property to go and do the deal that you're looking at next. And look, if that allows you to scale up quicker and faster and put more properties into your portfolio, then perhaps it's worth doing. That's something that only you and your situation can really understand. Next one is looking at below market value. So I gave you a bit of a sneaky peek earlier to what I mean by below market value, but essentially below market value means buying something for a price that is lower than the surveyor's value, like a RICS surveyor. A RICS surveyor goes around there, values the property, you're buying it for less, that's below market value, because that value is determined and the lenders determine their valuation by the RICS surveyor. So if you're buying it below that RICS survey, like I said, it's the purchase versus the survey value. So what that gives is security to the lender. So let's look at an example again. So if you've got £100,000 property, or it's valued at £100,000, but you're buying it for £70,000. Okay, you've negotiated a deal where you're buying that property for £70,000. That lender knows that if they're going to sell it, they're probably going to get £100,000 for it, because that's what the surveyor has valued the property at. They're probably going to get £100,000. But even if they need to drop the price in order to sell it quickly, they've still got a margin in there. So they could drop it to £80,000, for example, which is below market value. You're going to get buyers to snap it up, but it's still higher than the value of the loan that they've lent, because they've lent £70,000. So it gives that lender security from day one. Now, like I said to you before, when we were talking about source capital, that means that they're more likely to get to the full purchase price that they are able to lend. And source capital are absolutely a lender that does this. So they'll go up to 70%. So if you, in that situation, if you've got something that's worth £100,000, they could potentially lend you £70,000 to buy that property. If you're securing that property for £70,000, then you've just got 100% funding to purchase that property. So negotiating that below market value is really important. And I would say right now, because the issues that we're seeing from estate agents and the issues that we're seeing coming out of surveyors is that surveyors are undervaluing property, and estate agents are seeing a lot of fall throughs because surveyors are undervaluing property, because then the deal doesn't work anymore. So if you're able to negotiate hard to get that purchase price down as low as possible, then the deal is more likely to go through. Now, what we can do, because, you know, that was very straightforward, wasn't it? Property valuation, property purchase price. You need to make sure that the purchase price is significantly lower than the valuation. That's very straightforward, but it can be quite difficult to do. So how can you use contracts and finance and your understanding of property to then create that situation without actually having to ask the owner of the property to take a 30% hit on the purchase price? Well, that's where we can start to use creative finance. So we can do a split purchase. So the property price is close to the surveyor's valuation. So again, let's look at that same property, £100,000 valuation, and you cannot get the owner of that property below £95,000. They are absolutely determined that they're going to sell that property for £95,000. Well, okay, that's not a problem at all. But what you can then do, therefore, is split the purchase to lower the day one money. And what I mean by that, they want £95,000 for the property that is valued at 100. So you say to them, well, look, what I can do is, I really like this property. You give it the sell first. You know, this is really important. I don't ever want to give you the impression that I go straight into these conversations or these negotiations just blatantly speaking about what I'm going to do. There'll be a lot of rapport building. There'll be a lot of conversations. There'll be a lot of you know, finding out exactly what they want. And we'll get to that in a minute, because that is the most important thing that you can do throughout this entire process. But if I was selling to them, I'd say, what I can do is, how's about I give you, on completion of this property, I'll give you £70,000. Now you want £95,000, and that's absolutely fine. You will get actually more than £95,000, because I'll give you £70,000 on completion. That means that I can buy it, and I can buy it in a timely fashion. When I've refurbished it and then sold it on at the end, I'll then make up not only the deficit of 25 grand that I still owe you, but I'll actually give you another 10 grand on top of that as well. So in total, we've just agreed the price of 95 and I'm saying, actually, I want to give you 105. Now, the purpose of that is, and the way that that kind of deal can work is that I'm only giving them that extra money when I've already made my money. I've only paid them £70,000 on completion. Then I've done the entire project and then sold the project, because that's the terms that I'm just setting. And then when they come back to me and say, sorry, when I get the money from the sale of that property, obviously I put the money in my pocket, but at that point I can then pay them. So it's not actually costing me any more money at all. In terms of a percentage, it is costing me slightly more because I'm paying them more, but essentially what they're doing is leaving money in the deal and they become an investor in my deal. So I need to pay them a little bit more to incentivize them to do so. Now, again, just for complete clarity, I've been looking at a new family home recently. So I went to look at 3 properties last week, and you get into a habit of asking these questions. And I didn't meet any of the vendors, actually. This was all through the estate agents. But for every one of these properties that was selling, this would have been an option, because every single one of these properties had already bought their next house without selling this one. 2 of them had actually already moved out. But the reason that I can tell that makes it rife for this kind of structure is that they don't need the money. They don't need all the money on completion. Now, if they were moving out of that house and moving into another house, which they needed all the money for, then this wouldn't quite work, because I couldn't get them to leave some of that money in the deal. But because they'd already moved out into the next house and they didn't need all of the money on completion, because all they were going to do was put that in the bank or invest it or spend it or whatever, but they didn't need it for their next property transaction. So I know that they're perfect for this kind of sell. And actually, one of the houses I'm going to offer on when I finish this webinar, because I can make it work and the rest of my family really likes the house. So you split the purchase and then you incentivize the person who you are working with to split the purchase. You can then offer security like we talked about beforehand. So it works for everybody. So here we are, 200K, offer 100K, give them 150K at the back end once you've done your project. We look for this way of structuring deals all the time because it's perfect for lenders, for the majority of lenders as well. So long as you've got somebody who is happy with lending you against the value of the property and not the purchase price of the property. So you're really looking at bridging finance, or you're looking at peer-to-peer lending. The exchange with the delayed completion, we've already talked about a little bit. And then after this, I'm going to talk to you about how to conduct your conversations with the vendors. So, like we said, when you're going through exchange, you request a delayed completion from the vendor, and they're the one that has to okay that. And then you extend time between exchange and completion, and then you start to do the work. And I've produced another little graphic here so that you can see exactly what I mean. So let's explain it here before we move on to the next step. So here we've got an offer, then exchange, and then completion. And then the period between exchange and completion has obviously been elongated by that long arrow. And I've bought the property for £100,000, or I've agreed at exchange that I'm going to buy the property for £100,000. But instead of completing on the property at £100,000, I've done the work between that exchange and completion, as you can see from the hammer and the screwdriver. And now I'm going to complete on the property when it's worth £500,000. Now, for those of you that are a little bit savvy with the finance options here, what would I then be able to borrow from a mortgage company to buy that property? So it's now worth £500,000. Let's take for granted that a normal mortgage is going to be like 75% loan to value. Now, you're probably going to say that it's a significant amount of money, but remember, mortgage companies, and I specifically said borrow from a mortgage company, will lend me the lower of the value or the purchase price, and I'm still buying it for 100 grand. So the mortgage company would still only lend me 75 grand to buy that property, even though it's now worth £500,000. But again, coming back to my point at the very beginning of contracts and finance, if you understand contracts and finance, what you can do is you can buy the property on a one-day bridge and you can refinance after 24 hours. Now, that really only exists these days from companies that offer bridging and mortgages under one roof. You can't do what you used to do in 2008, 2007, and go on a bridge and then refinance onto a mortgage with a different company. It has to be done by the same company now. They're the only ones that seem to exist. But what you can do is you can borrow 70% of the value of that property from a bridging company, and you can use that to purchase the property. And then after one day, you can refinance onto a bridge. And now, because it's a refinance, it's not an initial calculation, you can borrow up to 75%. So you can borrow a normal mortgage to cover that, again, using a lot less money out of your own pocket. So if you were able to buy that on a bridge at 70%, that'd be 350 grand against that 500. Now, if you're able to borrow 350 grand because the property's worth 350 grand, that's more than enough to pay off the purchase price of that property of 100K and probably pay yourself back for some of the refurb works that you did, and also put some money in your pocket. An exchange with delayed completion can significantly reduce the amount of money that you need. Now, for the eagle-eyed amongst you, you'll say, well, hold on a minute, you haven't completed on that property, but you've just done some refurb work. So where is the money coming from for the refurb work? And you would be absolutely right. You either need that money in your pocket or you need to borrow it from an investor. But you're only borrowing it from an investor for a short period of time because you're already involved in that refurbishment, in that conversion work to get to that GDV to then to sell that property on. So an exchange with delayed completion is another really, really strong way to use creative purchasing. Now, before we move on to JV, I want to talk to you about vendors, because it's really important when you're dealing with vendors that you take the time to get to know what's motivating them. So I had a situation a couple of weeks ago where I was outside the front of I was meeting an agent outside the front of a property, and she said to me, we can go there on Tuesday and it'll just be you and me, or we can go there on Wednesday and the vendor will be there, but he's a really nice guy. He's just going to keep himself to himself while we walk around the property. Every single time I'm going to choose to go there when the vendor's there. And if I'm meeting the agent there at 2, I'm turning up at 1:30. Now, I did, to be completely transparent, I did ask the agent if she had any viewings beforehand, and she said no. So I knew that I wasn't going to be stepping on somebody else's toes. But I turned up there half an hour beforehand. I parked my car out the front and I stood out the front of my car, making it very obvious that I was going to be coming into this house. And guess what? The vendor came out and he started talking to me. Are you here for the viewing? He said. And I said, of course, yes. I'm a little bit early, but I just thought I'd stretch my legs. And then we just started talking about his situation, about the property, because that is absolute gold dust. Because the agent might not know. I can't rely on the agent to tell me about the vendor's situation. But in this case, I found out that, really nice old guy lived in the property since he was a kid, and he's now in his 80s. He wants to move into a different part of the town, but he's looking at downsizing. So he needs very little of the money that he's going to generate from this property to purchase his next property. So again, I'm thinking, right, that means that if he's got a low mortgage outstanding, he's going to pocket so much money that he only needs to take like 50% of what I'm going to give him for the property. So when we're looking at splitting the purchase, I can then go 50 and then 50 at the back end of when I finish the project. So I'm starting to structure my deal in a way that I know is going to work for him and win for him, but it's also going to win for me. And the only way that I've got that information is by turning up half an hour beforehand and meeting him there. Now, again, I didn't just go into that conversation with that guy and say, how much do you owe on your property? Because he'd probably have told me to, jog on. He's not going to tell me that information unless I've put a significant amount of work into building rapport, being incredibly friendly, and giving him that level of trust in me that, you know, he can tell me that kind of thing. I'm not here to just, you know, take the piss or be an arse about it. So I built rapport with that guy for a good 20 minutes before I started asking him some of the more invasive questions. But by that point, he was so comfortable with me that he was quite happy to have that conversation. Now, you might not have that level of conversation all the time when you're going out on property viewings, but you need to get out on property viewings to practice that level of conversation, right? It might not be necessary. You might go to a property viewing and you might hate it, and it might, you know, not really make sense, and it was much smaller than you thought, and you're not going to get the return that you're looking for. But that doesn't mean just walk out the front door. That means practice. That means practice with the estate agent, practice building rapport, practice your people skills, so that when you do need it, when you do need them for a deal to get yourself over the line, then your skills are honed. And that's what you should be doing. You should always be looking at the opportunity. Now we move on to JVs. And with JVs, it's, you know what, it's exactly the same. You need to get to know the vendor. You need to ask them what is motivating them. You need to find out what's motivating them. You need to understand them so that you can put an offer together that they think, man, this looks like it is absolutely tailor-made for me. That's what kind of reaction you want from them. So do they need to sell? So with JVs, what we're talking about is JVing with the owner of the property, because there are lots of different ways that you can work with the owner of the property. They can stay in the deal completely. Again, I saw a property just last week where the solution for that property would have been, well, actually, the person that owns it stays in the deal, and then I contribute the conversion costs, and then we sell it afterwards, and whatever it's uplifted for, we split 50-50. So at no point do I actually own that property, but I'm still making, I'm still pocketing the profit from an increase in the capital appreciation of the property. And if again, for those of you out there that are slightly more technical, that would be an assisted sale. So get to know them, get to find out what they're doing, get to find out where they're going, what they need on completion, where they're looking to invest, or if they're looking for another property for themselves. And there's infinite number of structures that you can put together. So what we do with our guys is the guys in our network, they put the property, they find out as much information as they can about the property, then they bring it to our support team, and our support team helps them structure these deals in a way that works for everybody. But the more information you can get from that information grab at the very beginning, the better you can structure those deals. So we have training, and that gives all of our franchisees the information, and you can get that information, right? There's loads of information out there that you can get hold of. But what we find is what makes the difference within our network is the support. It's actually having somebody that's going to double check everything that you're going to do. It's having somebody that's going to put their arm around you if something doesn't go well, or kicks you up the arse when you need a kick up the arse. We also send our guys leads. They're part of an incredibly collaborative and positive network, and also we provide funding. Now, what I'm going to do, and that to become part of our franchise, it costs £12,500 plus VAT, and then £245 per month, and that's it. You get unlimited access to absolutely everything that we do for the next 5 years. That's our website. We've even set up a property investors app for our franchisees. So our franchisees can sell their deals on the app. The app has got thousands and thousands of investors downloaded to it, and our franchisees deal with the investors directly, and then sell the deals directly to the investors without us getting involved, but completely on their own, with our training or with our support, if at any point during that process it is required. So we've also got Source Capital. So let me tell you a little bit about Source Capital, because there are still lenders out there who will lend you an amount of money that will help you get your deals done. So Source Capital, the way that it is structured is based on a GDV lender. So Source Capital don't look at the day one value of your property. They look at the end value of your property, and they're happy to lend you up to 70% of that GDV. And this is a bonus 6 strategy for 100% funding, because if you can borrow 70% of the GDV, that could be 100% of the purchase price and 100% of the build costs. Well, 100% of the purchase price and 100% of the bill cost is 100% funding. So sourced capital have, do, and will lend up to 100% of the costs to get a project done. So if it's £100,000 purchase price, £50,000 works, and the GDV is 250k, you can borrow up to 175k based on 70% of the GDV. So source capital assess deals like that. They make sure that the right amount of security is in deals like that, that the right amount of risk is in deals like that. And they can lend you up to 70% of the GDV. Now, to be completely transparent in the deal that for the figures in front of you, they wouldn't lend you £175,000 because you don't need it. They would lend you £150,000 if they were happy to lend you £150,000, because that's what you need for the purchase price and for the works costs. So that's just one of the ways that they'll de-risk it, but you're still getting 100% of the borrowing. They are a peer-to-peer lender. Like I said, they're FCA regulated, and they lend against the first charge of the property. So you need to make sure that you've got the first charge available for you to borrow money from source capital. But the only people that can borrow money from source capital are our franchisees. Now you can go onto the source capital website. You can look at the deals that are on the source capital website. You can see the deals that they funded. You can see the loan to values they funded. So in terms of records and evidence and credibility, it's absolutely all there. This is not somebody that we're saying exists that doesn't exist. You can see their credibility and you can see them registered on the FCA website. I just had a question. Do you have to be a franchisee to qualify for source capital finance? Yes, you do. Absolutely, you do. Source capital is only available to our franchisees to borrow from. Now, if you want to put money into source capital to get a return from, you can absolutely do that, and you don't need to be a franchisee for that. Again, go and have a look at the source capital website. You'll find all the information that you need from there. Here's a couple of deals that they've funded or are about to fund and have been agreed. So purchase price 577, current valuation 800, franchisee contribution. This is probably the, oops, didn't mean to go forward. This is probably the most significant one that you're looking at today, because the topic of this webinar is 100% funding. Franchisee contribution to the purchase price or the build costs is 0. Purchase price 577, current value 800, contribution 0, bill costs 255, GDV 1.6. There you go. I mean, that is something that has been, those numbers have been agreed by Source Capital and are waiting to be funded right now. Here's another one, 275, current valuation is 300, franchisee contribution in this one, and I would say this is because the purchase price and the valuation isn't a huge amount of distance between them. So we've asked the franchisee to contribute £3,300. The GDV is 470, giving the franchisee, I'd say, looking at that, about £100,000 profit margin. So they've had to put in £3,300 in order to get access to £100,000 profit. Not a bad deal for the franchisee. I've got another question right in here. Let me just go to it. Chris, does Source carry out any research on potential growth areas across the UK? Yes, we do. I mean, we have franchisees all across the UK. So what we tend to do is we will help our franchisees come up with the best strategy in their location. Now, if we see a potential growth area in the UK that doesn't have very many of our franchisees, we will market to that area because we want franchisees to be in that area because we see the potential of that area. So yes, absolutely, it is something that we look at, Patrick. Got one more. Hi, sorry, please can you clarify who calculates the GDV when works haven't yet been done? Thanks, Elaine. That would be the surveyor, Elaine. So the RICS qualified surveyor needs to go round to every one of these projects and give us a current valuation and predicted valuation based on the scheme that is presented to them. Be that HMO or flats or commercial conversion or whatever it is. But we give them a comprehensive understanding of what the scheme is going to be, and then the surveyor will give it the valuation. So the bonus seventh strategy, which I did mention earlier as well, I said I'd give you 5, I'm actually giving you 7, is to JV with Source. So all of our franchisees can JV with Source. And in that joint venture, what we do is we fund all of those upfront costs. We still use source capital to fund the project against the first charge. And then anything that comes in and around that, we cover that ourselves. Now, what that does, and what we see a lot of our franchisees, and actually we've had a lot more requests for this than we expected, because a lot of our franchisees want to joint venture with us because we do these projects, we do large projects, we've got a new build, we've got new build sites, we've got commercial conversions going on right now. We can do that kind of thing, but our franchisees, they might have only done flips before. So for them to get independent borrowing to do a commercial conversion, to do a new build site, would be very difficult. So what they do is they bring projects to us and say, look, I'd like to do this with you. And I want to do this with you guys because you have got the credibility to pull this off. You've got the know-how to pull this off. I'm just going to sit here and I'm going to learn. All the way through this, I'm going to learn. But then the brilliant thing for them is at the end of that project, they still get access to a percentage of that profit margin. Now, that whatever they contribute, that determines what their percentage of that profit margin is. But they're earning and they're learning at the same time, which means, and we've got an example of this right now in, I'm sure he won't mind me saying, Jason Kay in Hull. So the first project that he did with us was a commercial unit to 14 flats, and we did that as a joint venture. The second project, and we only got planning for this yesterday, is a commercial property that we're turning into a HMO. It's a 24-bed HMO. The third project that he's doing, he's going to do on his own. Because at that point, he's got the skills, he's got the credibility, he's got the experience to be able to do that third property on his own without us. And that's brilliant. So we've shared the profit margin in the first one, we've shared the profit margin in the second one. He's got 100% of the profit of the third one. And we couldn't be prouder of him. So for you, you don't need that upfront cash, and we're going to share the profit margin between us. So here's an example. I just mentioned Jason, but here's another one, because we do tend to do quite a lot of these. This is Chris Richardson. This was his first ever property project. This was a commercial building in Bournemouth, turned it into 14 flats for serviced accommodation. Chris set up a serviced accommodation management company and now manages the flats, even though we've sold them on to different people. So he's created another form of income from managing those serviced accommodation flats, even though we've built that between us, we've sold them on, and we've shared the profit margin, putting money into both of our pockets for doing that deal. Chris put nothing into this. In fact, during the conversion, in this case, Chris didn't want to be involved. He wasn't particularly bothered about learning about how to convert buildings. For the majority of this, he was actually in Romania. He didn't lift a finger on this, but he's created a business off the back of it, so he continues to generate income from this property. Now, what I'd like to invite you to is our Source Discovery Day, because on the 29th of November, we've got a Discovery Day in London where we're going to come down, we're going to spend a little bit of the morning, we're going to have lunch together, and then we're going to have a session in the afternoon where you've got the opportunity to meet franchisees. So look around some of our sites, because we're going to bring images and we're going to talk through our sites, and basically to ask us any questions that you can think of about Sourced, about property, and about how we can help you move forward. We'll go into the package that you receive at Source, because we haven't really talked about it today. And you can ask us as many questions about the technicalities of the property leads that we send to you. Or you can talk to somebody from Source Capital about funding. We're all going to be there. Now, we're asking to make sure that people are serious about coming on the day. We're asking for people to pay £30 for a ticket, but when you turn up, we will refund you that £30. We basically don't want a load of people to put their names down and then not turn up. So if you're serious about your future, if you're serious about property investing, if you're serious about building wealth, then put down 30 quid. We'll refund it when you turn up. Now, there's a link at the bottom of the page there, but we're also going to send out the link in an email, because I'm going to give you a couple of other things as well. I'm going to give you the recording for this webinar. I'm going to give you an investment guide, and I'm also going to give you our prospectus. That's going to be coming on an email to you straight after this webinar. So keep an eye out for that. The other thing that I need to talk to you about is our induction training, because whenever new franchisees join, they have to come on induction training. And we've only got one induction training left this year, and that's at the end of this month. So if you've been following Source for a while and you think that now's the time that you want to jump on board, you need to get in there quickly, and you need to make contact with us at the website, sorry, at the email address at the bottom of the page, franchise@source.co. You need to get in touch so that we can book your place, because induction training is nearly full. And at the end of this year, we're actually looking at the franchise, because we've got such a competitive package in comparison to everybody else in the market. There is a chance that our franchise package might go up. So if you want to secure this year's price, you need to make contact with our team right now. So thanks very much for spending the time with me this afternoon. It's been an absolute pleasure. I hope that you've got some value from it. I hope that you can see that, you know, looking at property as in terms of commercial conversions or HMOs or flips or whatever, that's only telling you part of the story. Really, if you look at property from contracts, from finance, from legislation, you understand the mechanics and you understand how property actually works. And you can start structuring property deals. You can start creating offers that can't be refused because they work with what the other person is looking for. That's what we're all about. We're all about understanding property and then putting it together in a way that works. So hopefully this has been advantageous for you. I've got a couple of questions which I'm just going to ask. Are you a member of a franchising trades organization? Bradley. Bradley, no, we're not. I think the one that you're looking at, is it, what are they called? I can't remember now. We've talked to them a number of times, and to be honest, there's just no benefit in us being part of the company that I can't remember the name of. But no, we're not. We do, however, Bradley, have 170 franchisees, and you're welcome to talk to any of those franchisees about their experience of being part of Source. And in fact, we've got a couple of them coming on the Discovery Day. So if you're interested in taking this further, either make contact at franchise@source.co or come on the Discovery Day so that you can meet these guys and you can ask them directly. How much is the course? We don't actually have a course, Sarah. We are a franchise, and for 5 years, it costs £12,500 plus VAT, and then £245 plus VAT per month. And our perspective is you get absolutely everything from day one, everything. Our help, our support, our training, our mentoring, the property leads, all of the software is available to you from day one. You're welcome, Bradley. Thank you, mate. Anybody else got any questions? That's me out of questions. So unless you've got any more questions right now, I will end this webinar. Oh, there's another one. How do you get on the Discovery Day? Gary, that is a great question. Oh, it's the Eventbrite link, isn't it? So the email that's going to come at the end of this webinar, or within 24 hours of the webinar finishing, Gary, to be perfectly transparent with you, we'll have the Eventbrite link on. You click on the Eventbrite link, you go to Eventbrite, you book your place, you pay your 30 quid, but then when you turn up on the day of the webinar, we will refund your 30 quid. And that's how you book yourself onto the Discovery Day. I hope that helps. Any other questions before I shoot off and get on with my day? In fact, the rest of my day, the first thing that I've got to do is go and have a flu jab, which I'm not exactly looking forward to. So please ask me questions. Gary, you're welcome. Thank you for thanking me. Hi, do you need the joining fee all at once? Yes, you do. Well, again, it's property, isn't it? So there's always a way around it. You don't need to pay it all at once, but what you do need to do is you need to pay it before you start. So we have had people that have paid us, you know, over a couple of months, and we have given them access to some things within the package, but not everything within the package, because that wouldn't be fair on the rest of our franchisees. But before you come on induction training, you need to have paid the full amount. So I hope that helps. Many thanks. You're welcome, Paul. Thank you very much for being here. Really appreciate your time. How much is the joining fee? £12,500 plus VAT is the joining fee. And that's for 5 years. £12,500 for 5 years. You know, look at the competitors in the marketplace. I can't believe that some of these guys they cost like 25 grand for a year. I mean, it's just ludicrous. How is that? There is intellectual capital involved, absolutely. But it just seems like a huge amount of money, which is why we don't try to compete with the prices. We don't put the prices up to that level because we just don't see it as fair. Thank you guys. Thank you. You're getting a lot of people thanking me and jumping off. So I think I will do the same. So thanks very much. I'm off to get my flu jab. I hope that you found this useful, and franchise@source.co if you've got any questions. Thanks very much. Cheers. Bye-bye.